All right, today we are actually we're still taking orders for the study pack or the textbook. Okay, people are ordering, people are sponsoring, so you can join. The kind-hearted people by sponsoring copies that will distribute to students for free, and then you can also support the course by paying the account displayed. Okay, in form of free donations. Okay, so we're going to actually post the free distributions here as well for everybody to see. So today we are looking at how to prepare asset schedules, or we call it non-current asset schedules. Non-current asset means fixed asset schedules, and then income statement for let's just say a hotel. When you say hotel, what comes to mind is accommodation. So let's say accommodation, okay, business. Okay, some use the word lodging business, but let's simply use what we know, hotel. Okay, but you must also understand that when the word or the term hotel comes to mind, okay, some believe that it is actually categorized as what we call hospitality. Okay, now, but one thing you must understand is that findings reveal that hospitality, okay, business, let's use the word business, okay, has broad categories. So the broad categories, you can be looking at accommodation, okay, or what we call lodging, or what we simply call hotel. And then you can also be looking at travels, okay. You can look at what they call theme park. Even sometimes we have some form of entertainment. You go to some hotels, they include that in their service list. So it goes on and on. Like, so whatever it is that tends to give that sale of comfort service, okay, is what we typically refer to as hospitality. But then even event, there's something called event management or event planning. There's something called event planning. Event planning is also part of hospitality. You see, so all these fall under hospitality. But then findings reveal that there's something that they also refer to as hotel industry. So under the hospitality business now, each category is trying to form an industry of its own. But whichever way you look at it now, okay, some hotels, let's say 5-star or higher star hotels, have all these inculcated into their service. What I'm saying is, if you go to, let's say, an Oriental hotel, okay, or let's say Transcorp Hilton, or let's say Eco hotels, you see all these sort of services, okay, inculcated into what they do. They do a couple of event planning, they do accommodation, they can organize, some sort of travels, they can also organize some sort of entertainment. So what I'm saying is that you can have a hotel business, doing all this in one word, pack. But then what I'm trying to say here today is that we are concentrating on the accommodation business aspect of the hospitality industry. Okay? Of course, you want to call event planning. You want to throw a party, you want to throw a particular gathering. You get someone who is an expert in planning an event, to plan that event from start to finish at a fee. So that's more like the revenue source for an event planning business. Okay? So in travels now, you can even come up with transportation. That can be part of hospitality as well. Okay, so but that is not what we're looking at. We're looking at hotel or lodging or accommodation as an industry. Okay, then you can say as part of the hospitality business. Okay, so that's for you to decide. But here now we're saying as an accommodation business. Okay, remember, as an accountant, you must understand where the revenues are. So basically, if you're looking at a hotel, let's say Oriental hotel for instance, what are the assets, the non-current assets that Oriental Hotel would likely have. Okay, you can visit there, to have a look, grab a Chapman or grab a drink and then try to have a view to understand what sort of non-current assets that they will have. Okay, as a hotel, they have land, they have building. It could be theirs, it could be leased, it could be, rented, whichever way. They have land, they have building. Okay, they have equipment. They can run what they call clubbing, okay, for their gyms. They can run restaurants and bars. Okay, so all these sort of centers that we call revenue centers, okay, is what they use to generate revenue for the business. So typically, if you have a hotel, you're going to have rooms. Okay, so the rooms can be categorized whatever manner that management decides. Okay, some can use countries, maybe African countries. So the highly developed countries are more expensive, the less developed countries are less expensive. So it depends on the model that the owners of the hotel want to use. Okay, so for the sake of argument, we can say okay, let's say room A, room B, room C. So if you want to book room A, it comes at a fee. Room A can come at, let's say, 1 million. Room B can come at, let's say, 2 million. Room C can come at, let's say, 3 million. So that means if you're spending a night in room A, you're paying 1 million. If you're spending a night in room B, you're paying 2 million. Room C, you're paying 3 million. So the idea is that the accommodation that they are giving to you per billing in each of these rooms is a revenue to the hotel. The hotel as well can operate a bar, or what we call a restaurant. In a restaurant, what do you have? You have drinks, and then you have different things, could be food on the menu list. You can order for them while you are in your room, or you can simply go to the restaurant or the bar, take your food there, and then come back to your room. You can decide, not even without even booking a room, to go in there, pick what you want to pick, and leave, depending on the way the hotel is structured or managed. So the idea, or what I'm trying to achieve here, is to let you understand where the revenues of the hotel business are likely to be. They give out the rooms at a fee. They operate a bar where you go buy things and pay. They have gyms. Okay, in the gym, you pay subscriptions to belong to the gym club where you can visit to do your exercises. Okay, sometimes they have what we call halls. They have halls where conference rooms where you can do your meetings, do your shows. You pay them, they allow you into the hall, do your shows, and then at a fee for using that space. Sometimes you want to do your meeting, you can book your conference rooms, okay, at a fee, okay, and that is more like a revenue to the business. So the idea here is that you need to understand where the revenues are. And now in the area of non-current asset schedule, or what we call fixed asset schedule, a fixed asset schedule is just trying to show the list of fixed asset or non-current asset the business has at a particular reporting period, showing the cost of the assets, depreciation charged as at that particular period from inception and for that current period, and the value of those assets after removing the depreciation. So if you have, let's say, 7 categories of assets, each of these categories, let's say 1, 2, 3, 4, 5, 6, 7, each of them has a cost. Okay, so at the beginning of the period, what is the cost? Let's say 1st January 2001. So these are the costs. So before now, how much have you charged as depreciation? We call it accumulated depreciation. You put it there. Okay, now how much are you charging for the year? We call it depreciation charge for the year. You put it there. Okay, so by the time you add, you get the application for for this year. Okay, so this is a cost, this is a depreciation. Then by the time you take this from this, you have what we call the carrying amount or net book value. So basically what you're using your fixed asset schedule to show or to tell management is to tell management or to know the cost of the assets at the beginning of the period and the cost at the end of the period after taking into consideration depreciation charge from inception to that date or time of what reporting. Of course, you understand that is more like accounting for what property, plants, and what equipment, and that means you must be familiar with your what international accounting standard what 16. Okay, so it means that as an accountant, you must also know where to what refer to the recommendations of the what of the standard setting board regarding a particular what item. So in order not to waste our time, let's also understand that as a hotel business, of course, every business has a tax what implication. So it means that an accountant must also be familiar with what with the likely tax issues that might come up while what reporting a particular hotel. Definitely, as a business, you're going to have to handle payrolls. You're going to pay as you enter, salary tax. Okay, of course, you're going to have to handle things like value-added tax. Value-added tax these days, I think 7.5%. And then in Lagos State, I want to believe other states too are trying to put that up. There's what we call consumption tax for hotels. Okay, now consumption tax, Lagos State actually brought that in to charge 5%. Okay, in order to generate revenue for the state, they charge 5% of services and goods consumed in a hotel. So it means that as a hotel, your services and goods that are aside from the fact that you're paying VAT, you're going to pay 5% of those value to what? To Lagos State Internal Revenue what Service. I believe some states are also trying to, in fact, have implemented or come up with such sort of what laws we call consumption what law. So basically, you must understand the tax. Of course, what we call withholding tax. Withholding tax is more like an advanced tax. Okay. So what we're saying is that when you give a vendor some jobs to do, and they send you an invoice, if you're paying them less a particular percentage. So we have it ranging from 10% to 5%, depending on whether you're charging a corporate organization or an individual. Okay. Typically, if you're charging withholding tax on what individuals, you are likely to what remit it to what Lagos State Internal Revenue Service. But if you're charging withholding tax on what limited what liability companies, you're likely to what remit it to what Federal Inland Revenue what Service. VAT is what Federal Inland Revenue what Service, same as your what corporate income tax. But then company income tax. So what I'm saying is that you must understand the tax implications or tax issues that are likely to come up under the what accommodation what business. Of course, you have as an industry, you have what we call the unforeseen circumstances or the contingencies. So it means you must also be familiar on when to what either account or by form of disclosure state if a particular happening is going to affect the decision or what they call the impression you're creating about what the reporting of a particular what business. Okay. Remember your IAS on what they call provisions and contingencies. I've explained this before, and I expect you. I think that's like the 7th. So I expect you to be able to know when to link happenings to recommendations of the international accounting standard. So basically, as a business, as well, that your double entry principles are there. Okay, you're giving an invoice for booking. If they are paying cash, then you're debiting your cash, crediting sales, okay, of what maybe room A, room B, or platinum, or whatever you're using. If they are not paying, then it means you're going to be having debtors. That means you're crediting your sales, you're debiting your client, okay. And then when they pay, what do? You debit your bank or cash, depending on what you've received, and then credit your client. Of course, when you make other expenses, raise your journals or raise your necessary documents required to document that very transaction and post them accordingly. So during the reporting period as agreed by management, you give them your reports. So the idea I'm trying to sell to you is that you must understand technically how revenues are generated by the business, and then you must understand how to also record them accordingly. Of course, you must also understand when to try to use the recommendations of the board to interpret certain transactions where complexities might likely cause various forms of interpretation. Of course, don't forget your concept and conventions can help you do all this as well. So quickly, let's take the question. Okay, so here we say from the following, you are required to prepare the non-current asset schedule and income statement for Lily Hotels Limited for the year ended 31st December 2015. So here we have the trial balance. Then we have bookings, silver space, bookings, gold space, bookings, platinum space. We have furniture, fittings and equipment at cost, land and building, vehicles, plant and machinery. We have accumulated depreciation on furniture and equipment. We have accumulated depreciation on vehicles and we on plant and machineries. We have restaurant inventories purchased, printing and stationeries. We have wages and salaries, repairs, payables, insurance, and then we have restaurant sales. We have gym subscription, conference and main hall charges, bank charges. We have bank, okay. Then we have owner's equity, and then we have bank loan, other running expenses and receivables there. So total we have 1.9 billion there. The debit side are going to the word credit. So we have additional informations there. Okay, quick one. We have additional information. One, depreciation is charged as follows: plant and machinery 31 million, furniture and fitting 70 million, and then we have vehicles 30 million. Then two, there we have prepaid insurance amounted to 1,230,000, and then we have what's there? Restaurant internal information. So let's quickly prepare what the question is saying we should prepare there. Remember, it's a hotel business, or what we call accommodation business or lodging business. Okay, or you can simply say hospitality. Okay, involving what? Hotels. So let us quickly solve the question so we can have an idea of how to prepare asset schedules and income statement. So the first thing there says asset schedule. So let's see how we can prepare that now. Okay, so we have Lily Hotels Limited. Okay, so they say we should prepare what? Non-current assets what? Schedule. Okay, I told you that the non-current asset schedule is a summary of the assets of the business. Okay, showing the cost of the assets and what, and the depreciation of the same what assets. Okay, so what I want you to understand here is that there's actually something that you must know, and that is trying to what understand how to prepare the schedule. It's basically trying to show the cost of the asset vis-a-vis the depreciation charged for what? For the period, and the carrying amount. Carrying amount also means net book value of the same asset at the end of the work period. So let's go. How many non-fixed asset do we have there? You must be able to identify the non-fixed asset there, or non-current asset rather. Non-current asset there. What do we have there? I can see furniture and fittings. Okay, so let's do it this way. So let's do it like this. So we have furniture and what? Fittings. Okay, so I can see what? Land and building. So we have land and what? Building. So I can see vehicles. So we have vehicles here. Okay, and then what else can I see there? I can see plant and machineries. So we have plant and what? Machineries, right? So of course, let's put our naira here. So we have it in, okay, 3 zeros short. Okay, so let's go. So remember, this year end is 2015. So what are we doing there? So as at the beginning of 2015, which is Costs as at 1st January 2015. What do you have for furniture and fittings? Furniture and fittings and equipment at cost, there's 350 million. So we have 350,000. So land and building is what? 650 million. So we have 650,000. Vehicles, what do you have? 150 million. We have 150. Okay. And then plant and machinery, what do you have there? 310 million. So we have 310 million. So you can even have a total column where you have everything there. Okay. So let's introduce the total column so that you understand what we are trying to do here. Okay, so let's call this total, right? So when you add this to this to this to this, you have a total here. Okay, so let's try. So we have 350,000, okay, plus 650,000 plus 150,000 plus 310,000. Okay, so what I have here is what? 1,460,000. Okay, so what do we do there? That's more like 1,460,000,000 there. So now they're going to say what? So if you add up this now, let's just say what now? Let's say we have accumulated depreciation. Okay, so what are the accumulated depreciation for furniture and equipment? I can see 140 million. So we have 140. Okay, so for what do you have there now? Vehicles, I can see 60 million. Okay, so what do we have? Plant and machinery, I can see 62 million. Okay, so there's no depreciation for what? Land and building. So what do we have now? We now say depreciation for the year. So what are you charging for the year? Okay, so what are they telling us? The additional information there you can get there. They are saying depreciation is charged as follows: plant and machinery 31 million. So here we have 31 million. Okay, so what do you have there? Furniture and fitting 70 million. Here is 70 million. What's the next one there? Vehicles 30 million. So vehicle here is what? 30 million. So what do we have? Okay, so we have 140, this plus this plus this, okay, plus what? 60,000 plus 62,000. Okay, so what we have here? We have 262,000. Okay, so what about this? We have 70,000 plus 30,000 plus 31,000. So what do I have here? 131,000. So if you add up this plus this, okay, so add up this plus this, 131,000 plus 262,000, we have 393,000. So if you add this, you have 00039. Okay, this is what? 00009. Okay, so this is what? 00007 plus 4, I think that's 11. So this 21, right? Yeah, so if you add this to this to this to this, you give you this. So let's try. So we have 21000 plus what? 90,000 plus what? 93,000. So we have 393. So that is it. So this, okay, at this level now, we'll now say what? Let's go. We'll say what? Carrying amount. This can also be net book value as at 1st January 2015. Okay, so that would be the cost minus the accumulation brought forward. So let's call this brought forward. Okay, so we can call this now accumulated depreciation carried forward as we're taking it to the following year. So now carrying amount or net value will be what? As at the beginning of the year will be the cost minus accumulation what brought forward. So we'll say, so let's go now. So let's say 350,000. Okay, excuse me. $350,000 minus 140,000. So this will be 210,000. Okay. Of course, this will still be the same thing because there's nothing you're taking out. Then for this one, 150 minus 60. That's more like 90,000, I'm not mistaken. But let's just do it for doing sake. 150,000 minus 60,000. So it will be 90,000 here. So 310 minus 62. 310 minus 62,000. It will be 248,000. So if you add all these together, put it there, or you can simply just say this minus this. So if you say what now? Okay, 1460000 minus 262000. So that I have 1,198,000. So this is the carrying amount as at 1st January 2015. That's the cost as at 1st January 2015 minus depreciation brought forward. Okay. Then we can now say what is the cost carrying amount as at 31st December 2015. So that will now be the cost as at 1st 2015 minus depreciation carried forward. Okay, that will be 350 minus 210 here. Okay, so we say 350,000 minus 210,000. So here now we have 140,000. Okay, so this one will still be the same thing. So 150 minus 90 here. What do you have? I think that's 50,000, I'm not mistaken. But let's move on. That's 60,000 rather. So 150,000 minus 90,000. That would be 60,000, right? So 310 minus 93. Okay. So we have 310,000 minus what? 93,000. So what do I have here? 217,000. So if you add up everything here, or you just say 1460 minus 393, okay? 1460,000 minus 393,000. So what do I have here? I have 1067000. So if you add up everything here, it should give you the same value. Just for a check. So let's go. We have 140,000 plus 650,000. Okay, plus 60,000 plus 217,000. 1067000. So this is what we call the fixed asset schedule. So as at the end of 2015, this is the cost of the asset, or the carrying amount of the asset, or the net book value of the asset. So this is the first thing that you have been asked to prepare. So we prepare the non-current asset schedule, or you can call it the fixed asset schedule. Okay, so that is it for what now? That's it for the what? Non-current assets. And the next question, let's say we should prepare what? The income statement. So let's go. What's how to prepare? You already know how to prepare income statement now. I don't have to teach you that. So we can just let's do that here. Okay. So we'll say what? Income what? Statement. Abi? For the year ended 31st December 2015, right? So let's put everything here. So let's call this our notes. Okay? So turnover, right? So let's call it note what? 1. So what's our note 1 here? Note 1, okay? So that's our what? Turnover, right? So what are turnover are the revenues of the business? What are the revenues of the business? Right? So what are the things I can see? I can see what? Bookings. Your bookings are so we have bookings. What? I can see platinum. Platinum there is 532222. 532222. I can see bookings gold. So bookings for gold. What's there? Gold space. I can see 242226. 242226. I can see silver space. Bookings for silver space there. I see 172230. 172230. So any other income items? Let's go there. Let's go. I can see restaurant sales. So restaurant what? Sales. What do you have there? 11010. So we have 11010. What else can you see there? I can see gym subscription. So we have gym subscription. What do we have there? 5,230,000. So we have 5,230. What's the next? I can see conference and main hall charges. Conference and main hall charges. So what do we have there? 3,012,000. So we have 3012. So any other income? Let's check if we have any other income there. There's no other income. But is there any additional information on those? No. So let's add up. Let's add up. Let's add up. So we have 53222 plus 242,226 plus 172,230 plus 11010 plus 5,230 plus 3012. Okay, so what am I seeing here? I'm saying what? 965,930. So we have 965,930. So what do we see now? See cost of what? Sales. Let's call it note what? 2. So we have note what? 2 there. So what are the cost of sales there? I can see restaurant inventories. That's like opening stock, Abi. So we have restaurant inventories, opening stock there. So what do you have? 2,200,000. So we have 2,200,000. So you add purchases. I can see restaurant inventory purchase 8 million. So we have 8 million. So we add 00201. That's 10,200,000. So what else do we have there? closing stock there, I can see restaurant went at 115, 2,850,000. So we have restaurant inventories, closing stock. I see 2,850,000. So we have 2,850,000. So you take that out, what do you have? 10,200 minus 2,850,000. So we have 7,350,000. Okay, so this is, you can call this cost of goods available for sales. You can call this cost of goods sold or cost of sales. Okay, so you have 7,350,000, right? So let's go. So that's what we have there. 7,350,000. So what do we have there? We have 965,930 minus 7,350,000. Okay. Of course, in your usual class now you have all this, so don't shouldn't be an issue there. So we have 9 million or 958,580. So we'll call this what? Gross profit. So the next thing I will say, what? Total admin and what? Running expense. Let's call that note what? 3. Okay. So we have note what? 3. All right. So let's go. We have note 3. So what are those admin what? Expenses that you have there? So we have what do we have there? What do we have? We have wages and what? Salaries. Wages and salaries. So we say what? Wages and what? Salaries. What do we have there? 333,750. We have 333,750. So what's the next thing there? Repairs. Repairs. What are the repairs there in the question? My repairs there, I can see. I can even see printing and stationery. The repairs there is 4,200,000. We have 4,200,000. Okay. What's the next one there? We have printing and stationery there. Printing and what? Stationaries. What do we have? 5,350,000. Okay. 5,350,000. So what's the next thing there? Insurance. I can see insurance, but you have to be sure if there's no additional what information. So additional information, let's even see there. Insurance here is 8,200,000. So we have okay. There's even additional information. Okay, it's on prepaid insurance. Okay, fine, we'll be good. Prepaid insurance there amounted to 1,230,000. Okay, so what's the insurance here? Insurance is 8,200,000. So remember, your prepaid expenses. I've taught you prepayment. If you don't understand what prepayments are, you can go to charlesconsult.com to take your class on prepayment. Prepayments are in form of expenses or income. So prepaid expenses are expenses that we are yet to incur, but we have made payment. So if you have not incurred an expense, you're making payment in advance. It's called prepaid expenses. But when you say prepaid income, it means that you have not earned the money, but you are receiving it. So let's assume that you're selling something. You've not sold that. The person has not taken the product from you, but the person has paid you. So that's more like an income in advance. Or let's assume that the place you're staying, which is rent, you pay rent. Let's assume that you've not even used the rent for next year, but you've paid the rent for next year. So that is payment in what? Advance, because you have not incurred the rent for next year, but you're paying. So those are prepaid expenses. So I've already taught in full what prepaid expenses are, or prepaid incomes are, and how to account for prepaid expense and prepaid income. Or let's just say prepayment, or let's say advances. I've taught how to do that in a class. So go to charlesconsult.com and take your class on prepayment. So basically, we have prepayment at start, prepayment at end. Okay, there's a way to adjust for it, but this is just at end anyway. So prepayment basically reduces what we charge. That's one at end, reduces what we charge for the year. So we have 8,200,000 minus what is the prepayment at the end of the year here? The question says what 1,230,000. So we have minus 1,230,000. So what do we have? So we say 8,200 minus 1,230,000. So that's 6,970. So what other item? So we have other running expense. Oh, I can see bank charges. Bank charges here is 1,180,000. So we have bank charges 1,180,000. So what else? Other running expense. We have other running what expense? What are the other running expense there? 10,200,000. So we have 10,200,000. So what do you have? Any other item there that you're yet to take? Okay, we've taken other running. We've taken bank charges. We've taken insurance. We've taken repairs. We've taken wages and salaries. We've taken printing and stationaries. Okay, so I'm just trying to check here. I'm trying to check to be sure that we've taken all that needs to be taken. Okay, so we've taken all. So by the extent, no, depreciation is also an expense. So we have to take depreciation now. So depreciation, since we have already prepared our asset schedule, we'll just come here and pick depreciation straight. So depreciation for the year, look at it here. This plus this plus this plus this. That gives us 131. So we have 131,000. So that's depreciation for the what? Year. So is there any other item we need to know? You can check again to be sure. Let's be sure we've taken all the incomes, we've done the asset schedules, we've considered the inventories. Okay, consider the inventories. Okay, bank charges, we've taken restaurant, no, we've taken printing, we've taken wages, repairs, we've taken bank charges, we've taken so that's it. So let's add up to get our total expense. Now let's add up. Okay, so we have 3,750 plus 4,200, right? Repairs, is it 4,200? Yes, plus 5,350 plus what, 6,970 plus 1,180 plus what, 10,200. Okay, that's for that. But then depreciation there plus 131,000. So we have total expense to be what, 4,926.50. So we'll come here, we'll say 4,926.50. So we'll take this out. So this should be our what? Net profit or profit for the year. Loss is when your expense is more than your income. Okay? For the what? Yeah, so this is what I'm looking for the year. So it's 958,580 minus 492,650. So I have 465,930. Okay, so this is your net profit for the what? Year. So this question has been able to help us understand how to prepare non-current asset schedule, what we call fixed asset schedule, and then prepare the income statement for what? A hotel business. And remember that at this level, if the business is what? A publicly quoted company, okay, you're required to show, of course, your earnings per share, IAS 33. So don't forget, as an accountant, you must know what is required of you per the standards. Okay, so you must be able to what, link them appropriately. Okay, and so now we have uh, the notes here explain how each item was gotten. Do you understand me? So this is basically explaining how these things have been what, prepared. Income statements, non-current assets was schedule. Okay, so now you must also understand that with this we can prepare the balance sheet, also called statement of financial position. We can prepare value added statement. Yeah, you can try a hand on that. We can prepare cash flow statement. We can also try to modify the statement, to show what we call unit reporting, or center reporting, where you want to know how bookings have fared. That is, how have we done in terms of selling room spaces? How have we done in terms of selling restaurants, inventory items? How have we done in terms of what, selling gym services? How have we done in terms of selling what, conferences and what we call halls? So you can modify your statement to show each of them in that what, category. So it depends on how your management or the owner of the business behaves. So you try to modify these statements in ways that suits their thinking pattern, or their behavior, or their need, or their requirement. Of course, not forgetting your concept and convention, your accounting standards, as it affects each item. Materiality items, okay, that will affect the way they will make decision based on what you're reporting, must be disclosed so that they will understand. Okay, so this is the question, okay, and this is the solution as well. So if you have questions, you can reach me on the numbers displayed, or drop questions in the comment section. I'll be there to reply you with the right answer. Don't forget you can support us, okay, by paying to the account displayed, okay, or sponsor copies of my textbook that we distribute to students for free. Thank you.